Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Chan, you're watching Indian Open. Let's go straight to the headlines. Asian markets retreat along with US equity futures after US health authorities said they found the first case of coronavirus that does not have ties to a known outbreak. Oil prices fell to the lowest in a year due to virus fears and a reported rise in US crude inventories. Warbug Pincus will invest 1,080 crore rupees in Apollo Tyres. The board has approved issuance of compulsorily convertible preference shares to an affiliate of the private equity firm. And communal clashes in northeastern parts of Delhi has left at least 25 people dead and more than 200 injured in the worst violence in the capital that witnessed in nearly 3 decades. I think the High Court has taken severe notice of this and asked the Delhi police to intervene at the quickest possible fashion. Let's hope this situation dies down, because the other bigger situation for world at large doesn't seem to be dying down. It's now spooking world markets almost every single day. We may have seen the US markets being in the green for better part of the trading day yesterday, but down they came afterwards simply because the coronavirus issues refused to go away. So about 0.5% lower, and you may think that this is not as bad as you would have thought, but remember, the Dow and the S&P were trading in the green for a better part of the trading day yesterday, and from there they came off and ended about 1% lower. And quite unlike the last 3 sessions, today as we are setting the stage to start trade, the Dow futures are trading in the red. 10 minutes ago when I checked, the Dow futures were down about 250 points. So consider a bit of a lag here and there. It is still down about 200 to 250 odd points. Almost every single day in the last few, the Dow futures have actually hinted at an uptick, and yet we've succumbed to selling pressure. I wonder what will happen today. Keep in mind, I think there is this chart which now shows about how the economic reality clawing its way back, because the markets are finally trying to converge or showing signs of converging to economic data. This is the US markets, of course. Keep in mind, we're talking about our markets, but there was a big divergence, and now there is a claw back to economic realities. And maybe if indeed the forecast for earnings growth coming off for the world at large come out to be true because of the coronavirus epidemic, or pandemic as we would like to call it, then we may actually have lower rates for the world as well. Asia is certainly pricing that in. You would argue that Shanghai is marginally in the green, but Hang Seng, Nikkei, etc., and Kospi and the other markets, which are all functional right now, are all showing a sign of a downtake. So we'll start off lower. The SGX Nifty 2 indicating a start which is lower in the session today, though off the lows of the day, but still lower for sure. Keep in mind, the other big factor to monitor is what all of this is doing to crude. And in the near term, the sentiment weighs in, but over the medium term, if crude prices stay lower, then that's a positive. It's continued to slip into bear market territory. NYMEX is at 48, and I think Goldman Sachs forecast for Brent, they've cut the barrels per day demand to 6 lakh from 1.2 million barrels per day, and the Brent forecast has been cut to 60 from 63 earlier. So you keep that at the back of your mind when you're looking at the world markets. Speaking of world markets, it's very important these days to get in a perspective, and today we get it from Frank Benzimra. He's head of Asian equity strategy at SocGen. Joins us right now on the phone line from Hong Kong. Frank, good having you. Thanks much for joining in. How are you penciling this in? The unpredictability, can it drag equity markets much lower? Because a lot of people are saying, oh, the damage is done and this is a dip that should be bought. My question is why?
What we on the equity market, we need to look at what kind of downside you had already, and if you look at the S&P 500, we are around 8%, something like this since the peak. And what we were telling at the beginning of the outbreak is that if we see some risk of a pandemic, if the things are getting worse, are getting out of China, there will be some correction on the global equity market of at least 10%. And this is actually what we are seeing, and this is for the first time in the last 3-4 days, or let's say almost since last Friday, we are starting to see the market reflecting the the downgrade in earnings that we will have without doubt when the company are going to report in the first quarter. So now the question is whether we will have just a 10% correction or something a little bit more sinister. And I think it is important to look at the mechanism of the market and what happened since the outbreak. And if you have one asset class which has really collapsed, it has been oil price. Year to date, I think we are probably more than 20% down now on the barrel, and this has opened the door for the market to start to reprice some Fed cut, to have the nominal yield rising. And in this context, you had all the so-called long-duration assets, so the tech companies, the software companies, the FANG, which did very well because what they need is to have lower and lower interest rates. But now the question is it going to be enough if the Fed is cutting interest rates? Is it going to be enough to support the market? And then this is really, it remains an open question. And what we think and the central scenario on which we are working is we still see a 10% correction in the market. So probably we are not yet down with the downside. But if the things are really getting worse, if the things are if the outbreak is getting to the US, then you could have some further downside.
Frank, just one more question. So we now have official confirmation from the WHO that the number of cases outside China are higher than the cases inside China. Is that proof enough for people to turn risk averse? And just a follow-up, are money managers, we've seen outflows from EMs at large, from Asia and from India as well. Are money managers wary of putting money to work, or are they saying that if this gets contained, we will put money back in a hurry?
Well, one thing that we could note on the last part of your question. So the positioning on the market, whether it is on the S&P or some Asian market, is not aggressively buyer and was not aggressively buyer before the outbreak. So, and this, for example, the hedge fund position on the S&P 500, they were pretty neutral at the beginning of January. So there is no heavy positioning on the equity, and we could expect that if we are seeing some sign of containment, and especially in Korea and especially in the country where there had been some severe contagion, then the market would very certainly rally. And if you look what's happening in the US, the short term is, from a fundamental point of view, is always very, very, very difficult to analyze, because you could say that roughly 80% of the volume are coming from algo trading. So then what you need to look is what the gamma positioning, for instance, or those kind of volatility parameters. And what you can see is that there have been some heavy selling cost by this algo trading, so it also means there could be some heavy buying coming back. So I would say that if we are seeing some containment, there is little doubt that we will see the market reverting to a more bullish view. Now, how we can position on the market, I think it is very important to be aware of the dispersion. The dispersion of the market. There is definitely some sectors that I don't want to touch wherever it is. Sure. Tourism related sector, it is not cheap enough. But other in the industrial sectors, they start to be very interesting.
Yeah, well, pertinent points. Frank, thank you so much for taking the time out and speaking to us early morning. That's the head of Asia Equity Strategy at SocGen, talking about the possibilities of large deployment into risk assets if indeed there are some signs of containment, particularly in countries like South Korea and needless to say China. But as of now, we are not seeing that. And the question is, how long does that last and what kind of earnings damage does it do? Well, time will tell. Well, India would have been an interesting one too. We touchwood thus far haven't quite seen that impact India, and maybe the earnings are a bit more inward looking and therefore may not have an impact. Very quickly, what could happen to the markets today in specific stocks before we move on to the first word news? Well, I reckon we are at the mercy of the global cues. So today, because the Dow futures are so lower, unlikely to see any meaningful support till the US futures recover, to be honest, and global cyclicals likely to remain under pressure. I mean, we've seen the kind of stress that companies like Maruti, Motherson, Hindalco, autos, global cyclicals have seen, and unlikely that that would change. And watch out for India VIX to its expiry date, but India VIX at the highest level since May 23rd, 2019. That's the extent of an uptick that we've seen in India VIX. Let's wait and watch how this one shapes up. Very quickly, stocks that you should monitor: HUL. It's an important piece of news. In all likelihood, the stock should be positive because the earnings synergies and the EPS accretion that comes in from this approval, or this because it's got the approval from the Chandigarh NCLT, that's very positive. It's anyways a defensive in nature, not exposed to global skews, and therefore very likely that it could react well. But you've got to keep in mind a couple of things when you're trading HUL, if you're trading HUL today. That one, while this was the major approval needed, last major approval needed, there is this question mark about GSK selling out HUL shares. Now, whether they sell it to the promoters or they sell it in the open market is a question that we don't have an answer to, or anybody has an answer to. That should be the determinant, but HUL could likely react positively today. Federal Bank in an analyst meet has reiterated its target of ROA expansion now to 1.25%. During FY21, they plan to launch the credit card business as well. Watch out for Federal Bank in the session today. A couple of brokerages have upgraded the stock recently, including Morgan Stanley. REITs and OFS, 5% stake sale by OFS. The floor price set at likely 298. Maybe that reacts negatively today. Bulk deal India Cements, 2 days on a trot, the stock has been higher. And well, I won't dwell too much on it because we'll talk about it on first word extensively. But Radhakishan Damani's name now appears, buying additional stake, 0.9%. And Gopikishan Damani, his brother, has bought additional 2.7% stake as well in trade yesterday too. So clearly there's some buoyancy here. Last but not least, Morgan Stanley believes that the correction in the city gas distribution stocks like MGL, IGL is an opportunity to buy. So do watch out for these names. However, let's tell you what's lined up on first word today. Nikki First Johnson to take us to the very topic I was talking about, Radhakishan Damani and Gopikishan Damani's newfound optimism on India Cements. Vishwanath then joins us to tell us just how much SBI subsidiaries contribute to its market cap. And I wrap it up by talking about PSU stocks and whether they're really deep pockets of value or value traps. Start with the big one, the biggest gainer in the last 2 days, and that's India Cements. Now, Radhakishan and Gopikishan Damani have bought additional 3.6% stake in the company. This comes just a day after Gopikishan Damani increased his stake by 2.8%. Analysts, though, don't seem to be as optimistic, but, well, these are marquee investors who put in the money, and therefore, are fundamentals hinting at an upside? That's the question that we can try and analyze out here, and Nikki's trying to do that. Nikki, good morning.
Good morning. On YTD basis, India Cements has clearly outperformed all the peers, be it larger counterparts, be it regional counterparts. They've all outpaced that number. Stock performance in the last two sessions has been rather encouraging, and what's the development out here is December quarter, we've seen Radhakishan having a stake of around Radhakishan Damani having a stake of around 4.7% stake in the counter. Tuesday, we saw an addition coming in by Gopikishan Damani, who's brother of Radhakrishna, by 2.8%, and yesterday we saw an incremental 3.6% stake being bought out by both these brothers now. So cumulatively, both the brothers now, according to the disclosures to exchanges, they hold around 11.1% stake in India Cements. That is from a time frame from December until now. So clearly you can see the quantum of interest that the two brothers have in this counter. Actually look at the reasons of what could be working for India Cement, which has led to these marquee investors actually check into the counter. We're going to start off by the cement pricing power back in South. Now, you know, the region has been scrapping until December, had been scrapping at the bottom of the barrel, but now come Jan, and we saw some amount of price hikes, especially in Andhra Pradesh and Telangana, where there was a price hike to an extent of rupees 50 per bag. Overall, for South region for the month of Jan, as per BloombergQuint survey, we saw a 30 rupee price bag hike also. So clearly some amount of demand revival scenario coming in there, which has led to the belief that if India cement within 16 MTPA capacity is clearly a good proxy play for that region. If the region overall was to see any kind of demand revival, the expectations are that the trend would continue going forward, and India cement would actually be an obvious beneficiary to this. What is also working in the favor of the company is the improving profitability, which is on account of two key parameters. First is the volume uptick, and second is the cost initiative measures which have been taken by the company in the past. If you look at the cost initiative measures that have been taken over the last 3 to 6 months from the company, it's the lower power consumption, which is on account of the HRS plant, which consumes less power, reduced logistic cost, and also shifting fuel mix, which means when pet coke is cheaper, the blend increases towards the pet coke, and when coal is cheaper, the blend automatically increases towards coal. So this makes cost control measures pretty much, favorable for the operational performance of the company. Improving profitability, if you look at the graph that we have in terms of the EBITDA per ton performance of the company, FY16 onwards, you will see the profitability coming down. But look at 9-month FY20, the number has actually increased. It's improved 680 rupees per ton as compared to nearly 513 rupees per ton. So clearly you can see that amount of cost measures and the volume uptick reflecting on the operational performance of the company.
But still, analysts, at least sell side, is not as optimistic, and that reflects in the upside potential of the valuations that are priced in right now.
Yeah, actually, if you look at the valuations, it's the cheapest of the lot that we have for India Cements. India Cements combined with Orient Cement, all these companies, they sit at EV per ton, which is a very key metric to look at how cement companies are valued, or how much capital you need to put in order to produce that one cement bag. That replacement cost is indicative that this number is at the cheapest that we have of the lot. Orient Cement, again, is a south-based player, because of which you see those valuations. There are a couple of concerns also which are plaguing this counter overall, but I'm going to first look at how Bloomberg consensus analysts have behaved, or rather rated, this counter over the last 1 year. If you pull that chart up where you have the number of buy, hold and sell recommendation, the number of buys from Feb 26, 2019 to Feb 26, 2020, that number has come down from 6 analysts to 4 analysts. Hold rating has increased. Sell rating, that has come down to an extent, but look at the return potential. A year back, Bloomberg consensus analysts said that there was an upside of 12% for this counter. At this point of time, they're saying 18% to 20% downside to the counter. A couple of things actually, Neeraj, which I would also like to highlight, which are playing on the downside for this company, is the increasing working capital of the requirements, given the kind of liquidity issues that overall the industry is facing, macroeconomic challenges. We're also looking at leverage balance sheet for the company. Notably, the company has also put on hold the expansion plan that it had undertaken 2 years back because of these funding constraints. So that's obviously 2-3 parameters which are not going down well with the analyst community, because of which you're seeing the downgrades also coming in the last 1 year. But then now it remains to be seen how big of a recovery story play is India Cements right now, because the kind of interest that we've seen in the last 2 trading sessions.
Yeah, well, 2 days on a trot has been doing very well, and the names are marquee. One of the most respected investors in the country. So when he's buying, you got to take notice. I'm sure he's seeing something that an ordinary investor is not. Nikki, thanks so much for highlighting that for us. And a story on this on our website, BloombergQuint.com. As also the next piece, SBI Cards and Payment Services. It's the biggest buzzword on Dalal Street right now, and it'll be a third group from the SBI stable to enter the public markets. But India's largest lender has many more from where those came from. According to internal estimates, the banks holding in its subsidiaries and joint ventures makes up almost 2/3 of the lender's market cap. Vishwanath Nair is here to explain how that adds up. Vishi, interesting math. Good morning.
Good morning.
Just explain that to us.
Good morning, Neeraj. So yes, but what we understand from a very senior official at State Bank of India is explaining how these subsidiaries have, how they stack up today. If you were to look at the bank is valued about, the market capitalization is about 2.9 lakh crore as of now. As compared that to the bank's holdings in all of its subsidiaries. Now there are 40 subsidiaries, joint ventures, multiple different companies spread across the world. These entities add up to about 1.9 lakh crore. So that's about 66% roughly of the actual bank's valuation, and that's an important metric to look at because yes, of course, one can expect that the bank has been undervalued, but also the fact that all of these businesses in subsidiaries, at least the major ones, your mutual fund business, the cards, the life insurance, general insurance, even SBI Capital for that matter, all of these companies are probably at the top of their game as far as their individual industries are concerned. And obviously there is value to be gained from each of these subsidiaries then. And you've already listed SBI Life in 2017. Now you're trying to list SBI Cards. That will happen in the first week of March. And then after that, the expectation is that the next in line would be SBI Mutual Fund. The CEO has already come on record to say that it's most likely some point in 2021 that they'll like to list the company. All of these companies help because for a bank like SBI, now there is very little core business related value to be gained because the size is so big that in the current macroeconomic situation, growing your book and thereby gaining value becomes more difficult. 23 lakh crore worth of loan book. So obviously, to grow even at 10%, you need to add 2 lakh crore worth of loans every year.
Which is huge.
Which is massive for any bank in the country for that matter. What happens then is you try and build out your subsidiaries, thereby gain value. You try and list them, gives you a lot of capital, gives you capital to boost whatever lending you can. Try and take on a little more risk because that is something that is missing in the Indian banking system at this point in time because of low capital base. SBI, of course, is very well placed in that matter, but still helps you. The idea being that each of these, especially SBI Cards, which is coming up now, that is at the top of its game, second largest card issuer in the country, the only pure credit card play company that is, I mean, apart from Bob Cards, which is a significantly small player. So obviously all of these businesses make a lot of sense, and their valuation being 2/3 of SBI, which is already undervalued, doesn't really surprise you as a number, but it's still interesting.
No, why do you say only pure play credit card company aside of Bob? Because I think we have HDFC Bank too having a significant...
So it's a pure play credit card in the sense that the company only does credit cards.
Okay.
So as opposed to HDFC Bank, which is a bank with a credit card business.
Right.
So
yeah, at some point of time, maybe HDFC hides that off, but that is when it does.
That is when it does, yes.
But essentially, the subsidiary valuation, which is right now at working for SBI maybe. Because Vishy, it's very interesting you pointed out simply because we're just doing this comparison since October 1st, 2019.
Yes.
SBI has actually given pretty stellar returns, and part of it could well be in anticipation of subsidiaries getting listed.
Yes, absolutely, because it makes sense, right? You've got some large subsidiaries left now to list. It would make sense for SBI to go out and list them. They're mature businesses and they can sustain themselves. Now, as the management was explaining when the SBI Cards IPO was being announced, that you need to do that because that is the only way that you can ensure the company does not depend just on its existing shareholder capital base and opens it up to the broader market. Makes sense that way.
Yep, 1 lakh crores likely market cap for SBI Cards when it lists. I mean, if indeed the bankers' conversations are to be believed. But Vishy, interesting. Thanks so much for putting that into perspective. And if you found this interesting, please log on to our website and try and read more about this. Okay, the last piece on First Word, we're talking about a PSU bank. Let's talk about PSUs at large. Stocks of government-controlled companies are back in vogue and back in conversations, at least if not in prices, because a number of brokerages and a number of money managers are finding deep value in them, which prompted me to wonder if that statement holds true or is it a value trap. The answer perhaps lies somewhere in between and is very, very bottom up. Now, if you look at across the world, right now the dominant theme is growth. Even currently, if you look at the ratio of MSCI World growth versus value, or value versus growth, whichever way you look at it, there's an inverse and it's trading at the lowest level since a really long time. This is, of course, growth versus value, and it's really turned topsy-turvy. If you do value versus growth, it will actually be lower as well. So that's the key thing. But the prominent theme being that a lot of people might be thinking the way Joel Greenblatt does, wherein that when you're making an investment in the first place, try and figure out what's the quantum of downside that you have to that investment. He said that one way to create an attractive risk-reward situation is to limit downside risk severely by investing in situations that have a large margin of safety. The upside, while still be difficult to quantify, will usually take care of itself. This is something that Joan Greenblatt has said in the past. Now, are people finding value in PSU stocks? That's the question. A conversation with Nimesh Shah, which is there on our website, seemed to suggest that ICICI Pru is certainly doing that. Now, just look at what some of the brokerages have said as well. For example, ONGC, CLSA said it's the world's cheapest E&P stock. That's their verdict, but which means that it is cheap. A back of the envelope analysis for NTPC suggests that it's trading at the best dividend yields that it's traded for years now. And the other point in question is the supply side pressure which has plagued these PSU names, and will that ease going ahead? Now just look at what's happened to the government stake in the 2 or 3 names that I really want to talk about: Coal India, NTPC, ONGC. Substantial reductions in these stakes for both for Coal India and ONGCS and NTPC at 54. This is as of December 2019. If you take into account the CPSE ETF that happened in January, then NTPC stake is now very close to 51, below which it is very unlikely that the government will not do a strategic stake sale. That's what they will do. They will not do another OFS or a CPSE ETF-led divestment in NTPC. And, well, the market would want to believe that at current point of time, maybe even for the others, there will be an OFS route preferred because in order to stop the price damage as opposed to the CPSE ETF. Now, is there growth here? That's the other question that people would ask. I tried to look at some of these names. Not all have growth, of course, but some of these have growth. NTPC, the expectations from brokerages is that it'll clock in higher profit growth for each of the next 3 years. Coal India, and I think we've done enough pieces on the website which show that it's expected to show volume growth of 5 to 6% in FY21 at least, and maybe more going ahead. Stocks like IRCTC, ITI, Mishra Dhatu Nigam, all of these PSUs have cited strong growth outlook in FY21. So not all PSUs are not growing. That's not the case. And brokerages have given their verdicts. I mean, for example, the CLSA note on NTPC that I was talking about, it says that 2020 is likely to be a year of focus on emission reduction at NTPC, improving ESG score, and benefiting investors as the company creates that expected 14% growth in regulated equity over FY20 to 23. They are talking about growth. It says that the stock can outperform in 2020 as it has the robust regulated equity growth, which should expand the ROE meaningfully for NTPC, which is a re-rating catalyst. JP Morgan says in ONGC, for example, that admittedly ESG, government ownership and stake sale are all issues, but a 6 PE stock trading at a 10% dividend yield with a net cash of 25% of market cap is value. So people are finding value, people are finding growth in some of these PSUs. The thing that investors, remember, you got to keep in mind is that the past has not proven to be very hunky-dory. Each of the times that you thought there was value in some PSUs, they've only destroyed well. These are the 5-year returns of some of these PSUs, and look at the damage that's happened. So who is to say that, if not the same extent, but a price damage or a price stagnancy will not happen even if you bet right now despite the value? Anybody's guess, and that is the big risk when you invest in these names, the history and the past performance. But yes, as I said, a lot of people find value in these companies at the current dividend yields and the valuations. And you never know, they might surprise in FY20, FY21, or rather 2020, 2021. Let's wait and watch. If you liked what I said, I've just given you a quick synopsis. The entire detail is on our website, BloombergQuint.com. So do try and log in and read that story. That's all that we have on First Word today, but lots more lined up on Indian Open. Pramod Gubbi, founder at Marcellus Investment Managers, joins in to talk about their investment strategy in the current time. We take a health check of the pharma industry with Keval Handa, former managing director at Pfizer, and business outlook with Shrivar Keruka of Borosil Glass Works. But after this break, a full tilt towards the day's trade.